All right. Good morning, good afternoon, and good evening, everyone. On behalf of the U.S. Commercial Service, we welcome all of you to an educational program during Export Week 2023. My name is Brian Beams. I am the Deputy Director for the International Trades Financial Services team and your host for today's session. Today's subject matter experts from Bannockburn Global Forex will inform you, the U.S. exporter, on the topic of foreign exchange or foreign currency exchange. But before we get to that, housekeeping item, everyone is on listen-only mode. This session is being recorded. If you object, please disconnect at this time. Participants can write in questions into the Q&A feature at any time during the presentation. Next week, we will send out the recording and resource materials to all the registrants. Lastly, the views and opinions expressed in this presentation may not necessarily reflect the policies and positions of the U.S. government. At this time, I will now like to welcome in Michael and Mark with Bannockburn Global. Michael?
Okay, well, thank you very much, Brian, for that introduction. If I may, if you could pass me the document.
All right, in theory here we go.
There we go. Okay, thank you. So we're going to be talking about foreign exchange today. There is risk in foreign exchange. There's economic risk, how the rates change, and then there's execution risk, getting the best level on an actual transaction. So our presentation today is going to cover two broad topics. It's going to cover the macro, what are the conditions that drive rates, and then we're going to walk through a couple real-life case studies of how companies have used foreign exchange and how to execute. Bannockburn is a market maker in over 90 currencies globally. We execute about $35 billion a year. All we do is foreign exchange. So this is our market. We have about $2.5 billion in capital and over 2,000 clients. And we're focused on relationship, execution, transparency. We're certainly available as needed. If any of you out there have specific questions, our contact information is here, of course. But today is all about education. And the first part of that education will be delivered by my colleague, Mark Chandler. Mark is our chief market strategist and one of the most well-known currency strategists on the street, and often seen on the CNBC and the other networks. So with that, I'll turn it over to Mark.
Great, thank you. Greetings, everybody, and thank you. And what I'd like to do is this is just a quick outline of what we're going to talk about with the macro, because we want to really understand foreign exchange and what moves the market, what moves the dollar's exchange rate, and just some sort of the characteristics of the foreign exchange market. So maybe the first place to begin is just to think about what does foreign exchange really mean. And in our world, if we had one government, there might be one currency. But the kind of world that we live in, something like 160 different countries, they all have their own currencies and different types of arrangements with that currency. Some currencies are pegged to the US dollar. Some have what we call a dirty float, where it's heavily managed. Others move freely against the dollar, just as the way equity prices or interest rates move by market forces. So does the foreign exchange market to a large extent. So businesses take on foreign exchange risk when they have revenues in one currency and expenditures in a different. That could come from exporting. It can come from borrowing. A number of different ways that companies have that foreign exchange exposure. And that's really what I'd like to talk about a little bit, is really thinking about, first we'll begin off with just the role of the dollar in the world economy. So Michael, if you could just give us that next slide. And so the best, most authoritative source for things when you're thinking about the size of the foreign exchange market and what instruments are traded is the Bank for International Settlements. It's kind of interesting because the Bank for International Settlements was set up to collect war reparations from Germany after World War I. But over the years, it's morphed. And now it's really a great source of data on the foreign exchange market and really a place where a lot of more academic but market-oriented papers and discussions are held. And they do a survey every 3 years about the size of the foreign exchange market. And you can see from this chart how amazing, how sharp the growth has been in our lifetimes. The average daily turnover, including all these different instruments that you see on the chart, and I could talk a little bit about them, but you want to get the idea that the foreign exchange market is huge. It trades 24 hours a day. My week begins Sunday afternoons when Australia and New Zealand open. And it ends at around 5 o'clock in New York when U.S. banks are no longer responsible for setting prices, for making prices for clients. So the 24-hour-a-day market, about 6 days a week, and the size of it is just mind-boggling. You can see from this chart, it's about $7.5 trillion a day. It's the biggest of the capital markets. And $7.5 trillion, I try to think about how to put that in some kind of context that can make sense to you. Here's one way to think about it. World trade in a year, that's all the world's exports in a year, is about $32 trillion. Today being Thursday, by the end of business today, in the foreign exchange market this week, we would see enough turnover to cover world trade for a year. 4 days turnover in the foreign exchange market covers world trade, annual world trade. Even that might not give you a great sense of the size of it still. Think about all the goods and services the world produces. The world's GDP. That's about $100 trillion. We'll do that in about 3 weeks in the foreign exchange market. And it's just an incredible amount of money changing hands. And to put this in perspective, right, this trade requires two currencies, right, like the dollar against the Mexican peso. So the dollar is on one side of almost 85–90% of the trades, which means that even though, you know, the kind of world that was there when we were born, maybe we call it the Bretton Woods system, where the post-World War II, the dollar is tied to gold, and everyone else tied their currencies to the dollar. That system broke down in 1971. And since then, we've ushered in this era of managed and floating exchange rates. The deregulation of the capital markets, the increase in world trade, the development of financial structures, all has led to this huge growth in the foreign exchange market, in which the dollar still plays a dominant, but of course not an exclusive role. So we look through these different types of foreign exchange products. The one you really want to, a couple that you want to focus on would be the spot, the blue bar, and spot is cash transactions. For example, it might be a business that wants to send a payroll down to a call center that they run in Mexico. They might decide just to send the dollars a day or two before payroll's due. That would be a spot transaction, cash transaction, just moving that money. The other one you want to look at is that outright forwards. And the outright forward is the spot plus time. So, for example, you might be buying a German machine tool. You might have to pay a little bit of money now, but you'll pay the rest of it when you get delivery. Well, wouldn't it be good if you could lock in today's prices for that 3 months when you get that delivery? That's what the forward market is about. My colleague Michael will talk a little bit more about that, because that's really where a lot of corporations, a lot of businesses use as a vehicle to hedge. The FX swaps, options, currency swaps, these are also derivatives that have particular needs or particular use, and typically much more for financial entities. So again, the foreign exchange market, 24-hour a day, just the largest of the capital markets. Maybe we could turn to the next slide here, Michael. What we're looking at here is there's one aspect of the dollar that sort of captures a lot of people's attention, and that is that foreign central banks hold reserves. And you can see from this chart that dark blue is the US dollar. It's sort of like what you might tell somebody, maybe your children, that when they move out on their own, they should have about 3 months' rent, cash, so security, holding it there just in case something happens. And that's what reserves are. It's sort of a rainy day fund for countries. Many countries have surplus savings, maybe from their trade surpluses, and they need to store them someplace. Foreign central banks hold foreign bonds as reserves, which means in the US's case, US Treasuries. So it's dollar-denominated instruments that make up about 60% of the world's reserves. You can see the other pieces of the pie here. That lighter blue is the euro, the second most used currency as a reserve asset. The brown is China. I know a lot of people see this in the news. Many people think that China is going to replace the dollar. If it does, it's not going to be anytime soon. As you can see, what a small slice of the pie of currency reserves that are accounted for by the Chinese RMB. There's a couple of other uses of the dollar that are more relevant to businesses, American businesses, than what foreign central banks may own. First is that the dollar is also a means of exchange. And by means of exchange, as many of you might have experienced already, when commodities and other goods are traded in the world economy, even if the U.S. is not involved or a U.S. company is not involved, the dollar plays a key role. So, for example, when Australia sells China iron ore, so China can produce steel, that iron ore is traded in U.S. dollars. And dollars are chosen because the dollar is liquid, it's freely available, and people are used to it. So there's an inertia factor, but also you think about all the great things that we sort of know about the United States: a strong military, the rule of law, the depth and liquidity of its capital markets. All these things play a role into why the dollar is the key currency when you think about the means of exchange. The recent development, partly because of sanctions and the U.S. use of sanctions against not only Russia, but Venezuela, Iran, several other countries, that many countries that are growing have thought they want to have an alternative in case they too get locked out of the dollar through these sanctions. They really began in the U.S. after 9/11, but have really spread now. We found it to be, I think the U.S. government found it to be a useful tool to try to, both as a carrot and a stick, to try to get policies more coordinated. But as countries seek alternatives, many countries have developed their own payment system. India has a payment system. Brazil has a payment system. China has its own payment system. What these payment systems have in common is that they typically are only good for that country's currency. So if you trade anything but Chinese RMB, you won't be able to use the Chinese system, for example. And these national systems haven't really been sewn together to make an international system. The international messaging system that banks use is primarily called the SWIFT system. And even though it's based in Europe, the U.S. is a large shareholder. And often when Russian banks got sanctioned, they were excluded from using SWIFT. So the SWIFT system is the primary system, even though the technological advances have lowered the barriers to entry for other payment systems. They are rising and they're being developed. And right now, though, they're primarily national systems. So we've talked about the dollar as a reserve currency. We've talked about the dollar as a means of exchange. And thirdly, third function of the dollar is as a unit of account. So, for example, Saudi Arabia's largest customer for its oil is China. Oil, though, is priced in US dollars. So even if China pays for its oil in RMB, which there's been talk of, the price of oil is essentially set in dollars, even if the payment is an RMB or a sterling or a euro equivalent. The dollar is really a unit of account for For a full range of commodities, there are a couple of exceptions, but for most commodities, the dollar, soybeans, Brazil sells soybeans to China, priced in US dollars. So the three functions of money that economists talk about: store of value, refers to it as a reserve currency; means of exchange, how transactions are made; and then as a unit of account. The dollar is the key currency in the world economy, and as American businesses, we're favored to be able to use that currency so widely. Other countries have to convert their money to be able to buy US goods or to buy other goods. So we want to talk a little bit about like what's driving the currencies, because it's $7.5 trillion a day. It's complicated, and what drives it. And I spend my time as a currency strategist focused on the drivers, trying to get a sense of what's moving it and by how much. So that next chart, Michael, will be helpful. There we've got what you can see there. If you can take a close look at it, you really have two lines. So I don't know why my blue line hasn't shown up so well, but the two lines there. One is the white line, which is dollar-yen exchange rate, and that's how many yen there are per dollar. So right now there's about 135 yen per dollar, right? Making the yen worth a little bit less than a cent. That blue line, which if you look closely, you'll be able to see, is what I think is the key driver for the dollar-yen exchange rate, interest rates. If you tell me which direction U.S. rates are going, I'll have a good idea which way dollar-yen exchange rate is going. Partly, as you probably already know, Japan is the only country that still has negative interest rates. Their policy rate, like the equivalent of our Fed funds rate, which is an overnight rate, the Japanese overnight rate is minus 10 basis points. Ours, after the Federal Reserve's rate hike yesterday, that would be May 3rd, the Fed funds, the upper end of the Fed funds target range is 5.25. So you can see what a big spread that is. And when you think about money, there's two elements of the price of money. There's the interest rate, how much it costs you to borrow that money, and then there is the exchange rate. And the exchange rate is really the price of your money in terms of another country. And so you can appreciate then why interest rate differentials, monetary policy, which sets interest rates, is one of the key drivers of the foreign exchange market in, say, let's say, a short to medium term. When it comes to the dollar-yen, I'd say that the interest rates is probably the number one driver. And because Japanese interest rates don't move that much, the interest rate differential between the two countries is primarily driven by the activity, by the change of U.S. interest rates. So maybe show you the next slide. And this is I should say one other thing before I'll keep the slide up, but just want to say that besides interest rates, the other main driver that economists have for foreign exchange prices is the external balances. That's a fancy name to say the trade balance, broadly understood. So it's not just goods, but it's also services. And imagine that a company like Coca-Cola, they might get royalty money from the overseas bottlers. That money comes back to the U.S., and that also counts as part of the trade balance, as if we're exporting a goodwill or brand. The other thing that gets measured there as part of the broad trade balance is tourism. And so, in effect, tourism is a service, and it's a service that you have to come here to the U.S. to pick up. Or, last year, my wife and I, to celebrate her birthday, went to Portugal. We had to buy euros. We bought the euros and we spent them in Portugal. That would show up in Portugal's current account. For some countries, tourism is very important. Mexico, Spain, several countries in Asia, Egypt, Israel. Tourism is very important for some countries and becomes a bigger part of that trade balance. The other thing that has become more important for some countries, especially Mexico, is worker remittances. So workers, say in the United States of Mexican origin, may send some money home back to their families. That also gets picked up in the current account. That worker remittances for Mexico, by the way, is over $5 billion a month. It's bigger than their trade surplus. So for some countries besides Mexico, Philippines, Pakistan, worker remittances is very important. Now, what this chart shows you is really the way the Federal Reserve and economists will look at the US dollar. This goes back to the end of Bretton Woods in the early 70s. This is what we call a broad trade-weighted dollar that's been adjusted for inflation. So real, meaning adjusted for inflation, broad includes a wide range of US trading partners, trade-weighted. And so you can see that there's been 3 big dollar rallies in our lifetime. That first big rally on the left-hand side of the screen, that's what we call the Reagan dollar rally, even though it began before Reagan was in office. Remember what's happening in the late 70s, the dollar is coming under pressure. We've got high inflation, stagflation, high unemployment. Volcker wants to squeeze out inflation from the system. He raises interest rates aggressively. We think interest rates are high now. We had double-digit interest rates in the late 70s, early 80s. But it wasn't just that the Federal Reserve was raising interest rates, but as to address the recession, the slow economic time, we had tax cuts and spending increases. Even under what people think is a conservative President Reagan, cutting taxes, increasing defense spending, increasing social spending. That policy mix, tight monetary, loose fiscal policy, typically is associated with an appreciating currency. Voila, we get the Reagan dollar rally. And that rally ends in September 1985. The dollar had gone so far that it began causing inflation to rise in other countries. Exporters in the U.S. were being squeezed. So the major countries met at the Plaza Hotel in New York, which these days is a condominium. And they agreed to intervene to drive the dollar down. We entered a 10-year bear market for the dollar. You can see the sharp decline. And then, around the mid-90s, we have another dollar rally. We associate this one with Bill Clinton, the Clinton dollar rally. But in fairness, it was partly about the tech boom. Think about what was happening at the time. You know, I had an account that I set up just for my son who was born in the late 90s. And all we had in there was, we called it Wintel. Windows, that's the Microsoft, as they were replacing typewriters with computers, and Intel for chips. I was able to send them to college based on that equity account. That's really what took the dollar up. The U.S. was carving out the internet, the sort of modern electronic economy. And it's not just the tech bubble that fueled the dollar's rise, but from the Plaza Agreement through the early 1990s, the U.S. had weaponized the dollar. The 1987 equity market crash was thought to have been sparked, or at least helped sparked, by comments from the Federal Reserve Chairman Alan Greenspan about Germany needing to open up its markets. In the early 90s, we had another Treasury Secretary, Lloyd Bentsen, who threatened to drive the dollar down if the Japanese didn't open up its markets. But in the spring of 95, as the dollar's on its lows, Bill Clinton replaced Lloyd Bentsen with Robert Rubin. And Rubin ushered in this idea that his mantra, if you will, was a strong dollars in U.S. interest. And that people are confused by what it means. You know, we had one vice president that said a strong dollar was one that was difficult to counterfeit. Nothing to do with the exchange rate. I think what Rubin meant was that the U.S. would not weaponize the dollar. We would not purposely try to deflate the dollar, depreciate it to help reduce the debt burden or gain a trade advantage. And that strong dollar mantra worked for about 20 years until around 2016. And as the Trump team took over, they re-weaponized the dollar, and it stays re-weaponized now through the various sanctions. So once again, we had that tech dollar, Robert Rubin, strong dollar rally, and it too raised to levels that became of concern for U.S. exporters and for other countries. And once again, in October of 2000, the central banks intervened to drive the dollar down, ending the Clinton dollar rally and getting us into another 10-year bear market for the dollar. The U.S. dollar has been rallying. You can see this third rally is partly after the great financial crisis, which was sort of the epicenter was here in the U.S. And we had a rule sort of first in, first out. U.S. Epicenter of the crisis was here. The U.S. aggressively responded to it. We came out first and were able to raise interest rates, helping the dollar. And again, post-COVID, the dollar has also been strong. You can see we're challenging those old highs. I suspect that the dollar has peaked probably last September and October. The sterling fell to record lows around $1.03. The euro had fallen to about 96 cents. But since then, the dollar has trended lower, partly on the idea that other countries will be, like the Eurozone, the UK, will be raising interest rates more aggressively than the US. And more recently, the market is beginning to price in very aggressive Fed rate cuts, perhaps because of the financial stress coming from the regional banks. You know, as we sit here today, the market's pricing in almost 100 basis points of cuts by the end of the year. And so with that, you can see that the dollar is reasonable that it probably is going to fall out of favor in a more dramatic way. That's what we call the real broad-weighted dollar, trade-weighted dollar that, I say, central banks use, the Federal Reserve uses, investors use to have a gauge about the real change in the dollar when you adjust it for inflation. Maybe we could have that last slide. And this is try to put it in context for you. Many small, medium-sized businesses that I have the privilege to work with are lucky if they can show a 10% profit margin. Floating exchange rates also means volatile exchange rates. That is, they move around a lot. And they move around more than many companies' profit margins. So here, you work hard to, and your company works hard to develop a product or a service that's truly competitive, high quality product. It takes a lot of time and effort to do this. Why would one want to give it all back and let the gnomes of Zurich, speculators in the foreign exchange market, $7.5 trillion a day market, multiple times more than the trade of goods and services? Why let that market take away your hard-earned profits? And what this chart shows you is the implied, which means implied in the options market, the volatility. Think about volatility, if you remember your math classes, standard deviation. How much does it move from its mean? How volatile is it? Because in the foreign exchange market, like the other capital markets, volatility means risk. And the risk is substantial. And this, we're not talking about on this chart, I didn't put any of emerging market currencies, because emerging market currencies are typically even more volatile. These are currencies from generally high income, that is to say wealthy countries, developed countries. Look at that, the Norwegian krone, 12% volatility. And this is a 3-month measure, annualized measure. So if you're selling a good to Norway, and Norway is going to give you this krone, you could stand to lose 12. I mean, just mathematically, right? It's telling you that you could lose 12% if you don't protect yourself. The Canadian dollar, which is our biggest trading partner, you can see has among the lowest volatility. And that's good for American businesses. It's conducive for trade. Highly volatile currencies are less conducive for trade. People don't want to take that risk. So that's why you might have a client in another country that insists on getting paid in US dollars or paying you in US dollars. Typically, I find that many countries, businesses want to pay you in their currency, but only want to receive US dollars. The important point of showing you this, I think, with this volatility, is to appreciate that while it is risky, that there are ways in which that the risk can be managed. And that's really what we're in the business of doing. Not just Bannockburn, but I think as many times as business, parts of our business function, Treasurer's Office, the CFO, with part of their responsibility is trying to manage that risk. And so I wanted to just give you a backdrop of what the sort of this creature, the foreign exchange market, the sort of contours of it, 24 hours a day, $7.5 trillion. Consider some of the drivers, typical ones that you might think about. interest rates, monetary policy, trade, trade surpluses. Those are generally the key drivers. And this chart, just to wrap it up before turning it over to my colleague, you just get a sense that floating exchange rates often mean volatile exchange rates. The U.S. had its most rapid period of development, same as Europe, when the currencies were fixed, when capital mobility was limited. But after 1971, currencies became increasingly floating, that is, free to move as the market sees them, private transactions see them, with those occasional bouts of central bank intervention. And the market has also created instruments to help businesses manage this currency risk that's inherent in what we do, trading or overseas investment. And with that, let me just turn over to my colleague, Michael, who's going to go through some case studies and give you some more concrete examples about how this currency risk that you take on can be managed.
Okay, thank you. Thank you very much, Mark. Appreciate that. So we know there's great risk in the fluctuation of these exchange rates. Even Canada is 6%, Europe 7.5%, and often there are unexpected events that occur, like Ukraine, oil, whatever may drive the market. So how do we translate that into what impacts your business? If you're doing business anywhere outside the United States, Mark mentioned buying a piece of equipment, you could be paying an advisor, paying a supplier, or you could be selling in a foreign currency and receiving revenue in a foreign currency. Those currency movements affect the amount that you're going to receive. And if you're a dollar functional currency business, any fluctuation in any of those exchange rates, whether you're buying goods or selling goods in a foreign currency, is going to impact that margin. Global businesses often generate these types of swings. So unless you understand the risk, and not just managing the risk, but executing to protect your business and protect your dollar margins. So 3 examples quickly: an importer who agrees to pay in foreign currency and an exporter who agrees to receive foreign currency for goods sold, or competition against foreign companies. We've had companies that had been selling in dollars for many years into certain markets, and as exchange rates change, their goods became less competitive and they were suddenly required to invoice their buyers in foreign currency. And likewise, many companies that were selling in the United States required as a supplier, required the buyers of their goods to pay in foreign currency. So the execution and market risk: we have imports and exports, foreign income, you might be receiving dividends, you might have an accounts receivable payable, you might have capital expenditures, you might be buying a company or selling a company. You may have invested in a capital structure. You may have an equity investment in a foreign country, which is the value of that investment is fluctuating due to the currency. You may have trapped cash. There are some countries like South Africa, as Mark mentioned, that are restrictive. The central bank in that country is restrictive of outflows in their currency. So it's not always easy to get access, but most markets are liquid. So what's driving this exchange rate volatility? First of all, the interest rate differential between the countries. If we were looking at Europe and the United States, and Europe were paying 10% on European government bonds, and the US is paying 1% on US government bonds, and the exchange rate between the euro and the dollar is 1 to 1, everybody is going to buy the European bonds, why not take the higher yield? But that's not how the market works. The market adjusts for that interest rate differential. So the rate you have today to execute in euros is about 1.1. And the rate on a forward market a year from now is higher than that. Let's call it 1.15 as an example, because the interest rate differential compensates you for that longer period of time. The market technicals and fundamentals, Mark has mentioned Canada, for example. What drives the Canadian dollar? Often oil prices. Canada is a big oil exporter. And as a result, if oil prices rise, the Canadian dollar strengthens. If oil prices fall, the Canadian dollar weakens, which is happening right now. Geopolitics, the war in Ukraine affecting supply, affecting the price of oil. Natural catastrophes. There might be an explosion at a refinery. There might be an earthquake. These types of things and general financial market conditions. Right now, the banking system in the United States, there appears to be some risk in the regional bank system and central bank policy, right? As Mark mentioned, are the central banks raising interest rates? Are they lowering interest rates? So these things are happening every single day, in every single moment. When we, on our portal, for example, if you're using our portal, we update our exchange rates every 15 seconds. That's how quickly rates change. So how can you protect yourself? First of all, if you're executing at all, you need to understand that you have risk. We've had clients that have an account at a bank, and there's no account opening required with us. We debit and credit through your existing bank account, so it's easy execution. But they say, oh, no, I don't have an exchange rate risk. I just ask my bank to debit my account and wire money to my Canadian subsidiary. Well, there's actually a transaction occurring there, a conversion from US dollars to CAD. So in fact, many companies don't even recognize that they have foreign currency risk. Do they budget? Most companies budget for their foreign currency when they recognize they have risk. They might set a rate for the year. And their profitability, their budgeted profitability is based on, hey, I'm going to pay 1.1 against the euro for the entire year for the $2 million worth of goods that I import from Europe each year. But in fact, the rate could be higher or lower. But it's important to set a budget and to look at forecasting. Avoiding the unknown. If you're hedging, and we're going to talk about hedging and what hedging is, you're actually locking in an exchange rate for a future date. So you can execute today and then execute a month from now when you have your next payment. And will the exchange rate be the same? Will it be higher or lower than your budget rate? You don't know. If you're executing the same amount every single month, you're effectively dollar cost averaging throughout the year. You're going to get the average rate throughout the year. But most companies don't have that steady flow of payments. They have maybe 2 million now, 5 million when they pay for the equipment when it's complete in 6 months. So it makes sense to take a look at the possibility of locking in an exchange rate today for a future date. So a spot contract is simply, hey, I'm going to take whatever the market gives me on whatever day I execute. Options, the foreign exchange market, as Mark mentioned, is extremely liquid, very high volume. Anything you can do in the equity markets, you can do in the exchange rate markets. That means you can do options, and you can set a level below which you are protected, above which you're not at risk. You can buy any option you'd like in the foreign exchange market, but options cost money. You have to pay for an option, just like you pay for a call or a put option in the equity markets. Forwards have no upfront cost. You're simply setting a rate for a future date today. And in that case, you're saying, hey, I don't know what the market's going to do, but I don't want to worry about it. I want to lock up that rate now and be certain what's happening. The key benefits, we had a company, for example, an amusement park. I had no idea, but haunted houses are built in Italy often for amusement parks. So they're paying $1 million for a haunted house at their amusement park. They want to pay $1 million for that haunted house. They don't want to pay $1.5 million if the euro goes against them, or 750. Their business is not speculating in foreign currency. Their business is running a profitable amusement park. They budgeted $1 million. They want to pay $1 million. So forward contracts are the purchase or sale of one currency against another at a set rate for a future settlement date, or you can even choose a range of dates. What does it do? It eliminates your exposure to the fluctuations in the currency over that period of time. You are locked in on that exchange rate, and you can use that money to make payments at the contract rate at any time. So you can match to a budget. A lot of companies, for example, if they're selling in a foreign currency, they might be bidding on a transaction. As soon as they've won the bid, they lock in a hedge to protect that revenue, to be certain that they get the margin they expected when they made the sale in the foreign currency. There's no out-of-pocket premium associated with it. Anything that the foreign exchange market earns, our company or other foreign exchange providers, is built into the exchange rate. So you have certainty of exposure, you have ability to forecast, and a lot of companies, the last point about layering into forward contracts, companies do it many ways. Some companies don't want to hedge everything. They'll hedge 50%, 60%, 70%. If they see the rate moving to a favorable level, like the euro was at parity last year, 1-to-1. If you're paying in euros, that's a very good time to buy euros, go long euros. So a lot of companies hedged more at the time the euro was weak. Some companies hedge 50%, let 50% be spot. Some companies hedge every single quarter. So each quarter they'll extend and they'll keep a year's hedge in place at all times. So layering any type of hedging activity, the market is completely flexible with respect to managing your risk. Now let's take a look at a specific scenario that illustrates what we're talking about. You've got a company in the US exporting wine to Canada. They're selling the goods in Canadian dollars for $1 million Canadian dollars. And they're expecting the buyer of the wine to pay in 1 month. So they've got net 30 terms on the sale of the $1 million CAD worth of wine. Now, they're going to have to sell 1 million of Canadian dollars in 1 month and buy US dollars. And today's spot rate is 130. And the company enters into a 1 month forward, which is also happens to be, it's a flat forward market. They lock it in at 1.30 for 1 month forward. Now, what have they done? The rate could move to 1.35. The Canadian dollar depreciates. If that occurred, the company, instead of receiving $769,231, they'd receive $740,000. And they'd have a loss against the time that they executed the sale of that wine of over $28,000. Obviously, if they had locked in with a forward, they'd be flat and they'd earn whatever they earned on their 769,000 sale. And if the Canadian dollar had appreciated if they had just done nothing and executed at the spot rate in 1 month, and the exchange rate was 1.25, they would have had a gain of $30,000. But again, what business are you in? Are you in the business of selling wine profitably to a Canadian company? Or are you in the business of speculating to the tune of $28,000 plus or minus on the exchange rate in Canada? Now, this is how the Canadian dollar's moved. In very recent weeks, we've seen over the last 6 weeks, let's say, we've had about 4% volatility in the Canadian dollar. We have a client right now that is domiciled in Canada and is selling in US dollars. So all of their expenses are in Canadian dollars, but all of their revenue is in US dollars. And as the Canadian dollar strengthened, it became more expensive for them to bring funds back from the United States. So they're actually leaving funds in the United States waiting for a better level. But what they're evaluating finally is the possibility of hedging for the year so that they're certain of how much Canadian dollars they're going to be able to bring in against their US dollar revenue. So that is what we're talking about. And I just want to emphasize that spot transactions and hedging transactions are both important. Hedging is not the only element of foreign exchange. Spot transactions, executing at the best level on any given day, because 80% of the market is spot, but 20% of the market is hedging. We should really look at best execution, whether you're executing on a daily basis or on a forward basis. So, Brian, thank you. Back to you.
Oh, thank you. I just would like to thank Michael Luton and Mark Chandler with Bannockburn Global for their time and sharing their knowledge and experience on this subject of FX. Next week, folks, remember you will receive a recording and resource material of all, not only this session, but other sessions you registered during Export Week 2021.